Now, let's spend some time in terms of understanding the three main concepts that drive the fixed income securities. One being the returns, the spreads, and the yields. So, as a core thing in this session, my focus is on understanding the different kinds of returns with prime focus on gross realized return versus net realized return, how we differentiate these two. Then we focus on spread. How do I really compute the spread for the data? What do I mean by the spread? Then we'll focus on yield to maturity, one important return based measure, right? It's another rate based measure which is important in pricing the bonds. So I'll try to talk a little bit about the yield to maturity. Then the profit and loss associated with an investment in a bond. What are the key components of that? Right, we'll talk about different components associated with the profit and loss as well as the return. So profit and loss is more in a dollar form, whereas the returns are more in some kind of a percentage form. And we will try to introduce what is called as a carry roll down scenarios, where we'll talk about a few important concepts like realized forwards and unchanging term structures. A few of these scenarios we will try to understand. So these are the few things that we are going to take up in this particular session. So let's get started with the gross realized return versus the net. So at any point in time, whenever I have to talk about the net, it is nothing but the gross return minus the financing cost. So especially for doing an investment, for buying a particular security, if there are any kind of financing costs, the gross returns minus the financing costs are going to give me the net return. So which means if the particular security has not been financed, no borrowing has been done for purchasing that particular security, then the gross realized return is similar to my net realized return. One important point for me to understand. So here, let's look at a small instance how we compute the gross return. Think a particular bond, the price of it at time t. Look at it as pt. So at time period t, the price of the bond is pt, where the face value is $1. When the face value of that bond is $1, I can see the price at the point t, I am calling it as pt. The same bond at time t plus 1, which is after one period, if I am saying that it is pt plus 1. So at time t, the price of it is pt. At time t plus 1, the price of it is pt plus 1. And during this time, let's say it has given a coupon which is C. Then what we are saying is the gross realized return during this period is nothing but the change in price, which is pt plus 1 minus pt. This is the change in price plus the cash flow that has come during this period, which is the C. This I am taking it as an overall proportion of the initial price. So probably if I assume that this is the price at which I have purchased the bond, this is the price at which I am selling the bond, and during this period the bond has given a cash flow of C. Then the overall gross realized return during this period is directly given by the change in price plus the cash flow during the period divided by the initial price. Now this is per one single period. Now the same thing I can very well look at it over a longer holding period also. Multiple periods also I can compute, but this requires I have to keep track of the returns per each of the periods, and even this coupon that has come out, I have to look at the reinvestment rate for this particular coupon. right? Probably let's take a simple example for us to understand it. Okay, the investor bought the US Treasury 4.5% November 30th 2011 on 1st June 2010. So it's a maturity of 1.5 year. The security is having a maturity of 1.5 year. The price of this particular, right, the price of this on June 1st 2010 is 105.856. Okay, suppose the price of the bond one coupon period later on November 30th 2010, which is PT plus 1, let's say is around 105. I want to find out both the gross rate of return as well as the net rate of return, assuming that the cost of financing this is around 0.2%. Now the coupon that would be paid is 2.25% of the face value, which is 100. So 2.25 will be the coupon that would be paid during the period. So let's look at these numbers. PT is 105.856. P T plus 1 is 105. The C is 2.25% or 4.5% by 2 times 100, which is 2.25. So these are the numbers that are there during this particular period. For a gross rate of return, I can directly take that these are the numbers, right? Now this, if I am trying to do a computation for the gross rate of return, I am simply taking it as PT plus 1 minus PT, and during this period there is a coupon that is declared. This entire thing divided by PT, giving me that the gross rate of return during this particular period is 1.317%. Now, if I am going with a financing cost here, okay, so this 105.856, I have actually financed it. So I have borrowed it at the rate of 0.2% per year. So at the end of 6 months, I have to actually pay on this, which is 1 plus 0.2% by 2. This is what I have to pay at the end of one period, because I have borrowed it at 0.2%. So if I remove the financing cost, now in this case my PT would be the upgraded one after taking into consideration the financing cost, which is becoming PT plus 1 minus PT, and during this period a coupon of 2.25 coming up. This I am dividing it by 105.86. This I will not divide by 105.96, because the initial price was only 105.86, which means my net rate of return here is coming out to 1.217%. And probably if I am looking at it, the gross rate of return, if you are looking at the other way of finding the net rate of return as per our formula, the gross rate of return minus the financing cost. So the gross rate of return is 1.317% minus the financing cost. This is per 1 year, but I am doing this only for 6 months. So even this should give me more or less the same kind of a number. So the net rate of return, whether I am computing it through the gross rate of return minus the financing cost mechanism, or from the basic conceptual part, whatever was my original, because if I have financed it at the final, I have to pay this much, which is resulting in an upgraded return for me during this particular period. And whenever we are talking about this particular scenario, I will always divide it by the investor's outlay only. because we are calculating the rate of return of the capital for that particular investor. So I will not take either this number, or I will not just look at how much proportion has been invested by the investor. In that case, it comes into a leveraged return kind of a mechanism, which will have a few set of problems. I am not looking at the leveraged return here, taking only the equity portion of the investor, but I am looking at the total return on the capital, and I am able to see that this equation is matching. But if the focus comes for multi-period, let's say I am talking about a 2 period like this particular numerical, assuming that the November coupon is invested at semi-annual compound rate of 0.6%, and that of the May price is 31st May 2011 is 105. So probably it's as good as saying PT plus 2 for me is 105, right? So now if I want to find out the gross rate of return for this entire period, right? What is that we are saying? Yes, the final value, right? This is the final value minus the initial value. Up to here, fine. And during this period, okay, after 6 months there was a coupon, but this coupon has to be reinvested. I am making an assumption that it is going to be invested at the rate of 6% per year, means 0.6% per year, which means 0.3% for that 6 monthly period. And in the next period again there is one more coupon. So these will become the cash flows during that particular period, and this I am dividing it by the initial value, which will give me, this is the gross rate of return 3.449%, and in this case if I want net rate of return, I'll take it as gross rate of return minus the interest rate during the period. Now this is for the whole year. I can take it as 0.2%, giving me that the net rate of return is around 3.249%. So this is how we operate the computation of the returns. So multi-period return, if at all I have to compute, it requires one, at what rate the intermediate cash flows are getting reinvested, and even the future financing costs. In the future, are the financing costs going to be higher, lower, or is it going to be equal across all the periods? Is there going to be any kind of a difference? All these kind of things have to be understood and covered. Now, the next topic that I am looking at here is the concept of spread. Spread is a very interesting concept when it comes to the measuring the relative value of a particular security with respect to others, and the convergence and divergence, to what extent the spread is narrowing or to what extent the spread is widening. That is a very important component of the return. When we talk about the profit and loss statement, we would clearly try to understand what are the various components of the return, wherein we would be talking of the spread also. The spread structure. Is the spread converging or is the spread diverging? This is an important point that we are going to look at. So what we are simply saying is, whenever we are doing the market price of a security, right, bond or anything, we are breaking it into two parts. We take some kind of a term structure. Based on this term structure, we are trying to find out what is the value of that particular security. So value computed using some term structure. And on the top of that, we are adding a premium or a discount, which is what is a measure of spread. That premium or discount is coming out as a measure of spread, which is expressed in the form of interest rate rather than in the form of prices. Right? So probably the better thing for me is to take a simple example. See, it's as good as if you see here, any bond that is there which is paying a coupon of S, if you see, I'm discounting it, the first coupon, I'm discounting it by 1 plus F1, the first forward rate. Then another one, F1 times F2, which is nothing but the 2-period spot rate. But for each period, we are adding some kind of a spread in such a way that the market price is recovered by discounting the bond's cash flows using the appropriate term structure plus a spread. Probably with an example, it becomes more and more easier for us. Now let's say this is the example that I am taking. Let me take the spreadsheet. Okay, this is the spreadsheet where I have all these different bonds that are available. These are the prices. These are the discount factors that I have derived from those prices. And just to recollect the conceptual part, from the discount factors, we can very well compute the spot rates. If you remember, from the discount factors, we had the mechanism of computing the spot rate, right? Because we simply said 1 plus RT by 2 times 2 power to the power 2t, right? RT to the power 2t times d of t is equal to 1. So from here we are directly getting 1 plus RT by 2 to the power 2t is equal to 1 by the discounting factor, and 1 plus R by 2 to the is equal to 1 by dt to the power 1 by 2t, and this becomes minus 1 and twice of it. Right, so this T is in terms of the semi-annual period. So this is what we are going to have, right? The time periods probably I can take as this is a 0.51. So these are the time periods associated with each of these periods. So from here I can find out the spot rates associated with each, which is coming out to 1 by 2 times 1 by dt. So this is 1 by dt to the power 1 by 2t, 1 by 2 times the t. So to the power 1 by 2t minus 1. So this is giving me that the spot rate here is around 1.149%, and across the period, if I am looking at the spot rates, these are the spot rates that are working out from these discounting factors. If I am going ahead, these are the spot rates that are working out from these discounting factors. And from the spot rates, we had a mechanism even to compute the forward rates also. The first forward is same as that of the spot. So the first forward is same as that of the spot. But from the second, either I can go with this is like an average of all the previous. So probably I can fill the forwards even in that manner just to use this. This spot should be the, so 0.353, whatever is the spot, should be equal to the average of 0.149 plus some x by 2. So it becomes twice this minus 0.149. If I want an approximated kind of a figure, this is nothing but twice of this minus this. This will give me the forward rate appropriately. The approximate forward rate that comes is 0.556% here. Now the same logic I can take it across, or I can do a overall simplification kind of an exercise also. Fair enough. But an approximation exercise also will not be a bad thing. And now again, in case of the third, what it is? 0.58 into 3, right? Because this becomes 0.58 is equal to 0.149 plus 0.556 plus some x by 3. So this becomes 3 times 0.58 minus the summation of all these. So basically it comes out like this number times 2 times this one, which becomes 3 times 0.58 minus the summation of all the above ones. Summation of all the above ones is what is going to solve the purpose for us. So here it is coming out to somewhere around 1.035% or something like that. Right, around 1.035%, and probably if I am taking it across, these are the different forward rates that are coming out for the different time periods. Of course, remember what I am doing are pure approximations, or I could have gone ahead in terms of solving them fully in terms of getting the actual numbers where the change would be there at the third decimal or the fourth decimal kind of stuff. Fair enough. Now what is that we are saying? Now, if I have to go ahead in terms of pricing this particular bond, right? The pricing of this particular bond, which is paying 0.75. So now I have to look at a particular bond which is paying 0.75%, means 0.375 is paid every 6 months, and on maturity 100.375 is being paid, because this is maturing on November 30th 2011. On the maturity 100.375 is being paid. So based on this I can find out the present value of all these cash flows by discounting it with, right, by discounting it by 1 plus rt by 2 to the power 2t kind of stuff. So this I am going to discount it with the spot rate, this by 2 to the power 2 times the time period. So which is giving me that the present value of this cash flow is this much, and this one also I am talking about this cash flow divided by 1 plus the spot rate by 2 to the power of twice the time period. So this is again coming out to 0.3736, and probably when I am taking it here, the total price of the bond is coming out to be the summation of these, which is resulting in some 100.2552. This is the price of the bond that I am getting when I am doing it through the spot rates. So this is coming out to be the price of the bond. Now what is that we are talking of? Let's say in the market the bond is available for 100.19 only. Right, the bond is available for 100.19, not 100.25. So that difference is coming out. So we'll say the market price is 100.19. Now that difference is coming because of the spread. Now here let me call the spread as, let's say, some 0.03%. Right? Now what we are saying is, when I am computing the present value here across all, instead of just taking the spot rate, I will add the spread, which is a constant spread here. I am adding the spread across all the spot rates. Right? I am adding the spread. If you see here, I am adding the spread across all the spot rates. Now here also let me add that same spread. Right, I am adding the spread across all the spot rates, and here also let me add that spread. So I can add the spread at the spot rate layer or at a forward rate layer, really doesn't matter. So I have added the spread, and this is giving me the price is 100.21, but I want it to be around 100.19. So if I am putting 0.04%, probably it's coming out to 100.195. 0.045%, 0.045%, it is 100.188. So it is very much closer, right? So probably I can set it using a hit and trial, or probably using a tool like GoalSeek in Excel, where I want the market price to be equal to 100.19 by changing this spread. And it came out that if I am expanding this, the spread has come out to 0.0437%. Right, 0.0437% or probably 0.044%, which is very much working out to 4.4 basis points. So I can say, or probably if I'm multiplying this by 10,000, so that I'll express it in terms of basis point. So it is very much working out to close to 4.4 basis points. Now this is what will say that the spread in this particular exercise for this particular bond, the spread is around 4.4 basis points. So the cheapness or the dearness of a particular bond is expressed in terms of the basis point. Right, so so instead of we are saying that the price is 6.5 cents cheaper, there are two ways. The price is 6.5 cents cheaper relative to the reference bond. I'm saying that this particular bond is trading 4.4 basis points cheaper compared to the reference. So that is one different kind of way we can very well express the particular pricing of the security in the form of spreads. Now, one important, another important dimension that we are bringing in to the bond mechanism is the yield to maturity. We have talked about different kinds of rates. We talked about the spot rate, we talked about the forward rate, we talked about the swap rate or the par rate. But what we see with all these things are, for different periods the numbers are different, which means I need so many rates to find the price of the bond. But what we see is, for a single bond, the yield to maturity is one single number. It's a one single rate, more equivalent to the internal rate of return of an investment. It's a one single rate which I discount the cash flows, which will give me, once I discount all the future cash flows with that particular rate, the present value is going to be equal to the price of that security itself. Right? So, which means for the same bond, or probably now let's say we have these many bonds that are there. Now for each of the bond, I can think of finding the yield to maturity. Yield to maturity is nothing but the rate. One single rate for this entire period. Now if you look at it, the yield to maturity for me, okay, number of periods, I can very well find out the time periods, right, because it's a semi-annual stuff. I'll say the number of periods are double of this. So these many periods, the PMT for each period, what is the coupon that is getting paid. This is the coupon that is getting paid. The present value, which is the price at which I am purchasing this particular bond. So because it's a cash outflow, I am showing it with a negative. The future value on the maturity, what is that I am going to get, which is 100. Now using these as the input, I am getting a rate here, which is the semi-annual. So probably if I am multiplying it with 2, I am going to get the annual yield to maturity. Now this I can do it for all the securities. Now what is that I could see is, this is like one single representation of each of these bonds. So the yield to maturity, if I am holding this particular bond until the maturity date, the annualized yield for me is going to be around 0.35%, 0.574%, 0.731%, which I could see is slightly lesser compared to the spot rates. 1.543%, 1.747%. It's slightly lesser than the spot rates. So, but this is one single representative of the entire cash flows at that particular. Now, if I discount all the cash flows with this YTM, right, in all the cash flows, if they are discounted by let's say all the cash flows that are coming up, all the cash flows associated with this November 30th maturity bond by 0.574%, what I will simply see is the present value of the cash flows would be exactly equal to the market price. So that's how we can find out the yield to maturity of the bonds from the price related data. From the given the coupons and the price, we can very well find out the yield to maturity of the bond. So this is one important thing, and it is primarily taking into consideration the term structure of the interest rates and even the spread. Both of them are being considered while it is arriving into this computation of yield to maturity. And one important thing for me to look at is when the coupon is same as the interest rate. Now if I set here, let's say just for the same time being, I set this particular coupon to be the same as the yield to maturity, right? Or I should set it at this layer. Let me set this coupon as similar as time to maturity. Here it's a circular reference error that is coming up. Okay, now let's try it. All right. So here the yield to, now one simple thing for us to understand is wherever the coupon, because we are using this as an output, but let me type it here, 0.574%. If I am typing the yield to maturity here, let me take out the circular stuff. Yeah. Now let me put again 0.574% if I am saying the coupon. But this price of it cannot be 105, so we'll have to adjust the computation. But yes, whenever we are looking at the price of a particular see, when the coupon is same as the yield to maturity, we will see that the price of it will be equal to 1. And when, so probably wherever we have the price exactly equal to 100, we should see that you see here, when the price of it is exactly equal to 100, we see that the coupon and the yield to maturity are the same, right? When I am seeing, okay, if you see here, let's say I set the price of it to 99. When I set the price of it to 99, coupon is lesser compared to the yield to maturity. But when I set this to 100, coupon and the yield to maturity are 100, are the same. And when I set to 102, I see that the coupon will be higher than the yield to maturity. Those are the things we are talking of. Whenever the coupon is same as the yield to maturity, we see that the bond will be selling at the face value itself. Means the price of the bond should be exactly equal to the face value of 100. But once the coupon is higher, if you see here, in this case the coupon is much higher than the yield to maturity. So the price is above the par value. But when I see that the coupon, if the price is much below the par, I see that the coupon will be much lesser than the yield to maturity. So those are some of the important, that is where we say where the price is greater than the face value, we call that that particular bond is selling at a premium, and when it is much lesser than the face value, we say that it is selling at a discount. But whatever it is, as the time to maturity is coming up, right? Another interesting thing, today this particular bond may be a premium bond. Today it must be sold at a premium, or probably it must be a discount bond. Let's say 5 years is the maturity of the bond. What we generally see is, this is what is the pattern that we observe. The price of the bond gets converged to the maturity, gets converged to the par value once it gets closer and closer to the maturity. And that is what we are simply calling as pull to par. So though the particular security is available at a premium or at a discount to the face value as of the current scenario, but when it is more and more approaching the maturity period, we see that the price will come closer and closer to the par value. That is what we are calling as the pull to par feature associated with the bond. But this is under the assumption that whatever are the spot rates and the forward rates that we have identified, they are going to be realized. When I say the 6-month forward 1 year from now is going to be some 2%. So after 1 year, if I am looking at a 6-month interest rate, it should be exactly equal to 2%. So under the assumption that the realized ones are actually, the whatever the predicted ones, whatever the computed ones are actually getting realized, under that assumption we can very well see that the pull to par psychology can very much work. Right, and that is what we are saying, but in some cases it might very well be possible that there could be a good amount of deviation as well if the realizations are not in line. And a few more interesting points, the YTM mechanism also gives me to compute the annuity associated, because annuity is like a recurring payment of the same value at different periods of time, which is generally used in the coupons payment as well as the fixed portion of the interest rate swap, the mortgage payments. So I can very well come out with the annuity factor, which is more and more associated with the fixed part, the coupon payment part associated with our equation itself. So even this equation helps me in finding out the value of the perpetuity. But the most important thing for me is, if the term structure is flat, the yield to maturity of all the bonds is equal to that rate. Now if the term structure is flat, all spot rates are same, right? That's the interesting thing. All the forward rates are the same, and all the yield to maturities are the same, and even all the par rates are going to be the same. So the number is going to be the same if the term structure is going to be flat across. But one interesting feature that we really have to understand here, whenever we talked about the yield, right? Whenever we talked about the yield here, the concept of the yield is always interlinked with the cash flows. because there is a dependency of the yield on the cash flows. Depending on how I am getting the cash flows, the yield is changing drastically, right? Now we can so what it means is yield curve is actually not well defined. When I'm saying yield curve, I'm talking about for different maturities how the yield is going to be. Until I'm defining the cash flows appropriately, is it a zero coupon bond, is it a par bond, or is it a premium kind of a bond? Depending on whatever is the kind of the bond, the yield curve will get defined based on how we are interpreting the cash flows associated with that particular bond, right? And in case of, at least this is one, but in case of those securities which don't even behave like that of a bond, like that of a coupon bond, like your amortizing bond, where even there is a principal repayment that is there in it, not just the interest payment, in that case the yield curve will be even more different. Because for me, the yield curve is the return across a particular period. That's it. The yield over a different time periods. Now let's look at it for any given maturity. I'm making a statement that the zero coupon yields will be more than the par yield, which in turn will be higher than the higher coupon yield. Now let's try pricing a particular bond. Right, let's try. Let's say these are the different, right? Let's say these are the different rates. These are the different YTMs, right? I'll talk about a bond. Let's say a zero coupon bond, which is paying me 100 on maturity. And let's say, right, let's say it is paying 100 on maturity. And so let's look at this bond which is maturing here. What is the yield that is associated with this particular bond? It would be more or less equal to the spot rate, right? If it is maturing here, the yield is going to be 1.76. If it is maturing here, the yield is 1.56, whatever. So these are the yields associated with a zero coupon bond. But let me assume that the same example where there was some coupon that is being paid. So these are the different kinds of bonds. We are seeing that in all these cases the yields are much lesser because there is a coupon that is getting paid. So the yields are getting much lesser here. Now if I am setting the coupon to almost zero, yeah, we have to change the pricing and all that stuff there. But what we are simply seeing is whenever I am looking at a bond which is a zero coupon bond, if it is maturing in the earlier periods, I am seeing that the yields are lesser. But let me consider the example of a 9% coupon bond. So I'll take it as 9% by 2 times 100. So 4.5 would be typically paid as the coupon. And finally here it would be 104.5 that would be paid. So these are the cash flows that are going to come out with a 9% coupon paying bond. So what should be the price of this particular bond? If I have to find the price of this particular bond, I can look at the discounting factors associated with each of these periods along with the cash flows. So the price of this particular bond should be somewhere around 130. This should be the price of this bond. And now what we are simply saying is, if I want to find out the yield that is associated with this particular bond, I can very well find out the rate wherein the number of periods for me is the same 4.5 years. So I'll take it as 9 years, 9 periods. Per period 4.5 is being paid. I'll pay 130 for this, and on maturity I am going to receive 100 for this. So this I am doing a multiplication of 2, which is giving me that in this case the yield is going to be 1.845%, whereas when it was a zero coupon bond the yield is 1.931. So though on one side, if the upward sloping term structure is there, across the time we see that the yields are going to go up. But for a zero coupon bond, the yield is going to be 1.931%. But for a bond which is a 9% coupon paying bond, the yield is only 1.845%. And now here you look at, if the bond is giving me a yield of 3 or 6%, if the bond is paying a coupon of 6%, then the yield is 1.879%. Whereas if it is paying a coupon of 12%, if you see here, if it is paying a coupon of 12%, I could see that the yield is 1.815%. So as the coupon is increasing, I could see that the yield is actually coming down, provided the term structure is an upward sloping kind of a term structure. Now if you see a few conclusions, the zero coupon bond has only one cash flow at the maturity. So the yield is similar to that of the spot rate of that maturity itself. But when we are talking of a higher coupon bond, 9%, 10%, 12% kind of bond, every 6 months some cash flow is coming out of that bond. So the yield is nothing but some kind of weighted average of all the spot rates. And all the spot rates are upward sloping kind of stuff. Means the spot rate of t plus 1 is higher than the spot rate of time t. So because of that upward sloping, there are so many periods for which I am using the smaller spot rates with either with small weightage as a part of computation of the average, which means obviously for the higher the coupon bond, more weightage goes towards the initial spot rates, which means lesser would be the yield that is going to come up. But if the term structure is sloping downward, whatever the statements that I have made, I have to reverse all those statements. So exactly the zero coupon bond is going to give me the least possible yield compared to a higher coupon bond, and a par bond may lie somewhere in between the two. So we have to understand the relationship between the coupons as well as the yield curves through this mechanism. Then that is what we call as the coupon effect. The fair priced bond, all of them, even if they have the same maturity, but depending on the coupons that they are offering, we are seeing the yield to maturities are different. If it is a zero coupon bond, the yield to maturity is 1.931. If it is a 9% coupon bond, somewhere around 1.84. If it is a 12% coupon bond, the yield to maturity is 1.815. So here, the yield to maturity is not coming out as the reliable measure of the relative value of the bond. So for a particular bond, the yield is higher does not necessarily mean it's a better investment. It's only the timing of the cash flows that are different. So relationship between the time pattern of the cash flows and the term structure of the spot trade, we see that the prices are going to differ. So that kind of a relationship is something which we need to be comfortable with. And in typically with the Japanese bonds, we don't see this kind of YTM kind of a mechanism. We generally look at a simple yield, which comes out with a very simple arithmetic formula. The coupon divided by the flat price plus 1 by T times 1 minus the price divided by the price. So this gives me the yield that is associated. This I am looking at the price per unit of face amount. If it is a premium or the discount, it's in the relative terms that I am taking up. Now, the essential part, especially when I am investing in a fixed income security, the P&L, the profit and loss that this particular fixed income security is generating, we are breaking it down. Different components we are trying to look at so that we can understand where we have made a profit, where because of what we have made a profit, because of what we have made a loss, right? What is the contributor to the profits as well as the loss. And this we do with the dollars. That is what we call as the P&L. And if I am written up all the elements of the P&L, if I am dividing them with the initial price, then the same analysis is getting done with respect to the return. So either I may do a P&L decomposition or a return decomposition, but the main intention is find out the breakup of the overall profit or loss that is coming up. I can do it with one single portfolio, with one single interest rate, or it could be a very much expanded to a series of portfolios, and even the spreads being constant, varying. Any of these things can very well be looked at. Here the focus is a few things. For that I am trying to look at the price of the bond given two things. One is the term structure, some term structure RT, and some spread at time T. Based on this, I say that the price of the bond is PT. And by the time I move to T plus 1, either my term structure might have changed, or the spread might have changed, might not have changed, whatever it is, but the price has changed. So that is what I am calling as PT plus 1. And during this period, we have some coupon. But in a relative, in a normal sense, we have already said that the gross rate of return is nothing but PT plus 1 minus PT plus C, the coupon that came during the period, divided by PT. This numerator is what we are calling as the profit and loss. And if I am dividing it by the initial price, it gets expressed in the form of return. Now I want to break this component, right? The different constituents, one based on the term structure itself changing, right? Is the profit or loss that I am getting is because the term structure itself has changed, or is it because the spread itself has changed? What is the contributor to the profit and loss? And because of that, I am making one simple assumption that in the future, by the time I reach T plus 1, I expect the term structure to be something. Expected term structure. I am expecting that the term structure is going to be something. So is the change in the price in line with the expected term structure, or has it changed drastically, and because of that I have made a profit or loss? So we are trying to break it down a little bit more. So from that perspective, we are taking some particular term structure which I am calling as an expected term structure at time T plus 1. It need not be the same as the term structure at time T or time T plus 1. This is not the actual. This is something which I am expecting that the term structure should be by the time it reaches the T plus 1. Whether it reaches or not, whether it realized or not, we are not sure of it. Now, this is where we are trying to bring out the total component. We know that the price change is nothing but PT plus 1 minus PT. So at that point, probably the term structure would have been RT plus 1 and the spread would have been ST plus 1. But when the initial period, the term structure was RT and the spread was ST. Now within this, what we are saying is there are three components. One, there is a carry roll down. Carry roll down is directly talking about the price at t plus 1 under the assumption that the term structure is going to a particular level which is expected. I have expected at time t plus 1. The term structure is going to be this much. We'll talk about there are different ways in which I can derive at this. Probably we have something called realized forwards mechanism or unchanged term structure, different kinds of assumptions that can be used to arrive at this. So some kind of a structure, assuming that at time t plus 1, the term structure is going to be this number. I am finding out what is the price that is coming out. What is the difference in the price? So that part I am associating it to carry roll down. Then assuming that the term structure has changed to a new number which is different from what is expected. So this is the unexpected part of the term structure. This is the unexpected. Here I am not saying that the term structure will not change. I am saying the term structure can change. If I say will not change, here also it will be RT only. But if I am saying the term structure will change, but it can go to some number. So if that is the case, I am going with what is the pricing. And if actually there is a much difference in the term structure, so what is the change in the price because of the change in the term structure without touching upon the spread? Spread is still the same. And the third component is due to the spread. What is the price? So there are three breaking up things. One is called as the carry roll down component. One is the rate change component, one is the spread change component. These are the three components that are going to impact the P&L of a particular security. Right now, what do we mean by this carry roll down? The other two are very clear for us. Right, the rate change because the term structure has changed and because of which I would have made a profit or a loss. The spread of the security has changed because of which I had made a profit or a loss. But when I am talking of carry roll down, I am talking about the price that is changing with the passage of time, rates moving to some expected. I have already predicted that the term structure will move from RT to RT plus 1. So here we are breaking it down into two components, one called as carry, the other one is called as a roll down. Everything else is constant, just with the passage of time. If there is a change in the price, right, just with the passage of time, even the interest rates are not changing. Just with the passage of time, I am looking at what is the change. That is what we are calling as the carry component. And the roll down part is if the security, as the security is maturing, if the cash flows are priced at the earlier points of the term structure, what is the scenario? That is what is the roll down component in it. Better example, I'll take an example that would make us to understand the whole breakup of all these. Now let's say for this same Excel spreadsheet based 0.75% November 30th 2011 from May 20th 2010 to November 30th 2010 I want to do this exercise. So for the 6-month period I want to find out what is its P&L. Right, for this initial 6-month period I want to find out the P&L, which is something which can really help us in terms of understanding all the three components, how we are bringing them out. So here if you look at the initial, okay, here we have got these are the forward rates. Right, these are the forward rates associated with each of the periods. And these are the spreads. Now we can talk about the initial forward. Now let me introduce. Okay, for us these are the forwards, these are the spread. Now forward plus spread, if I am doing for each of the periods, this is the forward, plus this is the spread that I have got. So for each of the periods, let's say I am adding up the forwards as well as the spreads. So these are the ones I am calling as the initial forwards. Now if we see, the initial forward for this particular security are 0.193, 0.6 and 1.079. Now using these three, if I am trying to find out the spot rates, right, because I can do the pricing of the bond using them. So I'll try to find out the spot rates here, which is nothing but the average of all the forwards, right, which is nothing but the average of all the forwards through this mechanism. So across, when I'm adding up the spread, so these are the spot rates, at least up to this period only I can do this exercise, because this is based on the particular bond which is expiring. So the spot rates are coming out to be these, which means I can find out the price of the bond which is paying this much of cash flow. No, sorry, here the cash flows are 0.37. Okay, this is the cash flows that are being paid. These are the cash flows. 1 plus the spot rate by 2 to the power of twice that of the time period. So here I am getting the price. The price of it, I can express it here. So these are becoming the prices, and finally when I am doing the summation of the prices, it is very comfortably working out to 100.19. So when I did forward rate plus the spread, and I converted them into spot, and I have used that to do the pricing of this particular bond, the price has exactly come to the market price. So if we see, the initial block is very much comfortable for us. So the initial price for me came out to 100.19 when I included both the spread as well as the term structure. So this is my initial term structure for the forwards, and this is for the spots. This is my initial term structure. Fine. Now I really want to see the initial term structure and the spreads as per the numerical that we have worked out. So that is where I have got these numbers. Now I want to see 6 months later, which is the 30th November 2010. At that point, we are saying the carry roll down scenario is realized forwards. So we are saying that the forwards are going to be realized in the future. So when the forwards are going to be realized, by the time I come here, this forward is going to be the same itself. So the 30th November 2010 when I am taking, right, 30th November 2010 forwards when I am taking, what we are saying, the forwards are going to be realized. So this forward will be the same, even this forward will be the same itself, right? The forwards are not going to change, the forwards are going to be realized, and which means because the forwards are going to be realized, I can even find out the spread also will be the same. The spread also is not changing. So I will look at the forwards being realized and the spread not changing. So these are the ones. So by the time that I am coming to that particular period, I can find out the spot now. The spot now is nothing but the average of this particular forwards. Right now the spot rates are going to be these two numbers, at least for the two periods when I am looking at, these are going to be the spot, which means I can find out the present value of the bond now, right, assuming that the forwards are going to be realized. So the present value is going to be, here I am going to get 0.375, but this time it is divided by 1 plus this by 2 to the power 2 times this minus 2. So because this has to be to the power of or minus 1, because 1 period lesser is what I am trying to look at. So this one is coming out to be the present value of 0.37 and here around 99.54. Overall coming out that the price of the bond in this case is coming out to some 99.91. Because now I have moved 6 months later, I have to adjust the discounting factors accordingly, because I am right now on the 30th November 2010. So the price of this is 99.91. So 99.91. So from 100.19, because of the carry and roll down. What is the carry roll down here? I am assuming that in the future the term structure is going to be the realized forwards. And if the term structure is going to be the realized forwards, these are going to be the spot rates associated with them. Using that particular spot rates, when I am trying to find out the present value, this is what is coming out and the price is coming out to be this much. Which means because of this, there is a loss of around 0.28. So the carry roll down is contributing a loss of minus 0.279 or 0.28. Probably if I expand this a little bit more, right, it is minus 0.278 itself looks like. So this is minus 0.278 or 279. Then the next step we are talking of is the term structure falls in parallel by 10 basis points. Now that's a rate change. Now I am saying that the term structure is actually falling by 10 basis points. Though I have initially started off that it is realized forwards is my expectation. But in reality, the term structure has fallen by 10 basis points across. And which means probably, yeah, now let me keep a eye on these things separately rather than expanding the stuff again. Now what I'll do is I'll change the term structure, decreasing it by 10 basis points. Right, 10 basis points is 0.1%. I'm going to decrease. So the forwards I'm going to decrease by 10 basis points, and because of which you could see here the forwards are becoming 0.5 and 0.979, and based on this I am getting that the number is around 100.01. I am getting the value, the price as 100.01. Earlier it was 99.91. Now it has become 100.01, and because of this there is an increase, and that increase is to the extent of 0.099. The increase is to the extent of 0.10 or 0.099 depending on the rounding off that we are doing. So that is because of the rate change. The rate change has actually given a positive value here. Then we are also talking about the bond spread converging from 4.4 basis points to 0. So because of that, probably now instead of 4.4 basis points, now if the bond spread is becoming 0, the price of it is becoming 100.05. Right, the spread as the bond price has become 100.05. Again there is an increase of a little bit, which is by 0.043. So that is because of the spread. So overall change in the bond price is because of these three components, which is really working out to minus 0.135. So minus 0.135 is the change in the bond. So which means probably when I do a pricing, it is as good as saying from the original number of 100.19, from the original number of 100.19, I see that it has fallen to 100.01. No, sorry, 100.054. So from 100.19 there is a fall to 100.054, which is minus 0.136 is the typical loss that has come out in the process. So there is a loss of minus 0.136, and that is what we are talking of as the price appreciation. Right, minus 0.136 is the price appreciation. So PT plus 1 minus PT is minus 0.136. But if I have to talk about the P&L, even the coupon has to be added. So I am adding up the coupon, which is 0.375 during this period, which is creating a plus 0.239. And of course, if there is any kind of a financing cost, I'll subtract even the financing costs to arrive at the P&L, adjusted P&L after removing the, and if I am doing this entire thing, if I am dividing it, so this 0.239, when I am dividing it by the initial price, which is 100.19, that is what is going to give me the return. So this is though on an overall scale I can say there is a loss of 0.136, but doing this decomposition exercise I can very well make out whether in which, because of what I have actually lost and because of what there is a positive movement in the price, which is the major culprit. If there was a fall in the price, which is the major contributor if there was an increase in the price. So that's an interesting aspect comes with respect to the P&L decomposition kind of an exercise. So just to finally look at, whenever I am talking about that rolling down scenario, carry roll down scenario, the most common thing that generally people use is the realized forward, which means whenever I go into the future, whatever I have taken as the forward rate now, that forward rate is going to be realized. So I'll go with a simple assumption that whatever I am mentioning as a forward rate now, it is the expectation of the future rate itself, and this particular forward rate will be realized in the future. So whenever I am going with that kind of an assumption, I can very well assume that in the future the forward rates are going to be the same as what I have expected in the past, using them to do the pricing of the bond and finding out the profit or loss. So it simply means that if I am looking at today the 6-month rate 2 years from now, when I really move to 2 years now, after 2 years when I see what is the 6-month rate, it should be exactly the same as the 6-month forward rate which I have determined now after 2 years. Right? So this is where the decision with respect to if those two are exactly coming out to be the equal, it hardly matters whether I have invested for one period and after that doing the reinvesting, or going for a long-term investment directly. Both of them are equally profitable. But if I am saying that the realized forwards are greater than the implied, the actual forward rates are much more higher, then probably it's better that I invest for one period and after that reinvest it for the next period. But if I am seeing that in the future the forward rates are going to be much lesser than what I have found out at the time of pricing, then it's better to go for a long-term investment itself. And this kind of an assumption very much assumes that there is no risk premium that is built into the forward rates. They are not going to change So no kind of risk premium is going to come into the forward rates. On the other hand, we can very well look at another kind of an assumption for carry roll down. One is that unchanged term structure. So as the word itself is saying, the term structure remains unchanged. So here, this was the term structure, right? Probably the spot rates, I could have seen that the term structure here is somewhere around this. Now, what we say is this numbers will not change. Whereas here, if we have seen, the term structure has actually changed, right? These numbers, probably these are the numbers. Earlier, these were the numbers. So, I am making an assumption that the term structure will not change in the future. So, whatever, so the same 0.149, these would get carried over here, right? Which means here, if I am saying this is a 6 monthly rate 6 months from now, or probably this is a 6 monthly rate 6 months from now. Even after 6 months, I'll say the same. The 6 monthly rate 6 months from now is going to be 0.556%. 6 monthly rate 1 year from now is 1.035. Even after 6 months, I'll say the same. 6 monthly rate after 1 year is going to be 1.035%. That is what we are calling as a term structure being unchanged. Whereas here, it's very clearly taking into consideration the risk premium, which is increasing with the term in case the term structures are upward sloping. And sometimes even for this, there is an assumption that makes that unchanged yields, assuming that the bond yield will remain unchanged, not the term structures, but the bond yield is going to remain unchanged over the period. But this is a very unrealistic assumption to use. So very comfortably, people use either the for the computation of the P&L, either the realized forwards mechanism or the unchanged term structures kind of a mechanism. So overall, we have had a good understanding and discussion with respect to the returns. We have understood the spreads comfortably. We have seen what is yield to maturity. We focused a little bit more in terms of understanding the component of the P&Ls and the returns and the different scenarios that are associated with the carry roll down situation. So this is what we need to be comfortable with in terms of the return spreads and yield to maturities. A little bit of more focus in terms of doing a bit more practice problems will give us a hold in terms of computing an appropriate profit and loss statement for the investment returns of the bond, right?